All right, welcome everybody to another episode of the Bull and the Cub. Special guest Tom Brodie, National Account Executive at CSSI Cost Segregation Services. I'm so excited for this one because we haven't had an episode yet on how to save money on your taxes yet. There's a lot of ways to do that, but this is an important one, and it's going to be an exciting episode for our listeners because many people are frustrated with how much they have to pay in taxes, and they want to pay their fair amount, but they say, I'm paying too much. How do I find ways to save on what I'm paying? And if you're fortunate enough to have an investment property, or you're looking to invest in property, this episode you want to listen to and understand what Tom has to share about not just deductions for depreciation, but special ways to do cost segregation services. So excited to have you. Thank you so much for joining us.
Well, I appreciate the opportunity. This is gonna be great.
Fire away, David.
Let's start with the basics. What is depreciation and how do depreciation deductions usually work?
Depreciation is it's the government's way to help you offset the cost of owning a building, right? Because you're gonna have to invest money in your building to maintain it. So depreciation is a way to take your building's value and be able to write off a little bit of that every year, right? And a lot of times people just they let the CPA do that, and that's fine. But at least you should have the input into how you want that depreciation recorded.
Yeah, that's it. So how does the math work? I mean, we'll get into, David will get some more detailed questions, but how does that math work? If if some people on our listeners, may own a townhome, and just for simple math, maybe they own a high-end townhome for $1 million. I
Yeah.
mean, doesn't it appreciate as time passes? How does the depreciation deduction work?
Well, yeah, the value does go up. You're right. That value will go up with the market, but the depreciation says, okay, if it's $1 million condo, the economic life of that condo in accounting terms is 39 years. So you're going to take $1 million divided by 39, and that's the amount of your depreciation expense every year. Okay. So that's how that works. When you're talking about cost segregation, it's all about accelerating that depreciation, or I like to say correctly recording the depreciation, because most of your building assets are not going to last 39 years. You're going to have to replace some of those things. And so the cost segregation breaks it down into faster depreciating categories. And that's where you can actually kind of like recording the depreciation correctly. So you're going to write off things that are not going to last 39 years. You're going to write those off faster.
No. Go
Um,
ahead, Dave.
how did you get into this specialty?
Yeah, it was that's an interesting story. This wasn't, I got a college degree in finance, so we had a fair share of accounting, but went to work for Shell Oil I was in Shell Oil for 27 years. So this was something after I left Shell, I was looking for something else to do. I kind of stumbled into this. And once I looked into it, I said, well, everybody's got to be doing this. There's going to be no opportunity for me because this is a no-brainer. Why wouldn't you do this, right? But the reality is not many people know about it because their CPAs don't talk about it and they don't help them pursue that. So this is really a big untapped market. It's starting to get a lot of interest, and people who are looking for ways to lessen their tax liability are pursuing this. But there's a lot of people out there that still don't know anything about this.
Yeah. Well, so before, David, you get into the cost segregation part, let me do some, because our listeners sure love math. Let's give some simple math for the listeners just to give context for basic depreciation deduction. So if I follow Tom, if you've got paid $1 million for a property, a residential property that you're going to rent out, and say, that's going to be allocated 200 grand for the land, 800,000 for the actual building itself. I think it was 39 years is the kind of depreciation timeline. So the 800 grand you paid for it divided by 39 gets you something around $20,000 a year of a deduction on your taxes. So you may be renting that out for $50,000, right, a year. That's income. Normally you're getting taxed on $50,000. You want to find ways to deduct that $50,000 that you're earning as income on that property every year, so you're not paying taxes on it. You can obviously deduct for property taxes, insurance, but now that's not going to get you where you need to get. You're still going to be paying taxes on that rental income, but you also get a standard deduction, or a deduction, I guess, for about 20 grand a year in that scenario. So that's your basic depreciation deduction, if I follow, and we'll get into the special knowledge you have on cost segregation in a moment. But if I have that right, I wanted to share that with our listeners.
Yeah, that's perfectly right. I mean, because you said, just remember, you're going to have maintenance that goes into your property, right? Upkeep and things like that. So the depreciation, the idea of it is that depreciation write-off or expense is to help you offset the costs of annual maintenance on your building.
Perfect.
If you had 60 seconds to explain cost segregation to a teenager, how would you do it?
Okay. I think it's just like we talked about it. Why would you depreciate something longer than you're going to have it, right? So if there's things in your building that you have to replace in 5 years, why would you continue to depreciate that over 39 years? Why wouldn't you write that off sooner? So that way the write-off is going to match when you have to replace it. I mean, that's the whole idea. So this accelerated depreciation that we're kind of talking about with cost seg it's another method. So the straight line depreciation, which you take, your $800,000 divided by 39, that's an acceptable method. That's kind of a shorthand way to do it. It's not the most accurate way to do it. The most accurate way is to break down your building into its component lives, right? So the 5-year assets, the 7-year assets, and then depreciate it accordingly. So that way you're doing it absolutely correct.
Right.
Don't
And
know
by
that
doing it correct, you're deducting more up front. You're getting a bigger deduction now, which is great. Right.
it's all about time, value, and money, right? And so when I talk to people about this, and they say, well, if I have it for 20 years, I'm going to get all the depreciation, right? And I say, okay, if you won the lottery tomorrow, $2 million lottery, you want to wait 40 years to get your money, or do you want the cash value? And I'll ask you guys, what's your answer?
I'm greedy. I want my money now so I can invest it.
Exactly. So that's the same exact decision that a building owner has. The best thing about that, unlike the lottery, they're not taking a discounted cash flow. They're just going to record the same total dollars. They can record a lot of that, about 30, maybe 50% of that value sooner. And their write-off is going to be worth more because a dollar of expense today is worth more than a dollar of expense in the future as far as the dollar value. It's all about time, value, money.
Can you walk us through some real world of examples of how a building owner would save significant taxes through cost segregation?
Absolutely. If I can share my screen here, we'll see. I've actually got an example. So let me just kind of walk through this.
Yeah, for those listening on the traditional podcast venue, you gotta get on the YouTube version of this to see what the slides. But so that's just a plug for our YouTube channel. Go right ahead, though, Tom.
Yeah, I'm going to walk through this. So cost segregation really is it's looking at commercial buildings a little differently, and it's going to depreciate them faster. So we talked a little bit about the two different types of buildings. So it's as far as their economic life. So you've got like retail stores, office buildings, hotels. Airbnbs is in that hotel kind of category. So that's a 39-year economic lived asset. The other one is like rent houses and apartment complexes. That's residential rental. That's a 27 and a half year. So it's a different life. But what straight line depreciation does, and this is what most CPAs do, is they say, okay, well, I've got this bucket of assets, and in that bucket is going to be the cost of the building. Not the land. You have to subtract out the land, just the cost of the building. So they're going to divide that total cost of the building by either 39 years or 27 and a half years, depending on what type of building it is. And that's your depreciation expense.
That's the basic math we did earlier, right? The shortcut.
Exactly.
Right.
Exactly. What cost segregation does, I'm going to continue using the bucket analogy here. We're going to break it off into different buckets. So you've got your building structure, which is 39 or 27 and a half years. And then things that are called tangible personal properties, that's 5 or 7 year assets, depending. Then you've got one that's called leasehold. It used to be called leasehold improvements. Now it's called qualified improvement property. This is more like for office buildings and things like that. And then you have land improvements, which are things outside of the building. Now, to give you a little bit more detail, here's some of the breakdowns. Like for the building structure, and you've got your foundation, your external walls, HVAC, plumbing, electrical, all those kind of things that make a building that allow a building to stand. That's in the structure, right? Then you got the tangible personal property, which is carpeting, floor covering, cabinets, countertops, specialty electrical and plumbing, which is over and above a regular electrical. And then the leasehold improvements are your interior sheetrock renovations, interior plumbing, and electrical connections and paint. The land improvements, which is a big one, the parking lot, everything outside, irrigation systems, security systems, landscaping, lights, flagpoles, all those things. Once you've got it broken up into those categories, then the real fun comes in and you can start applying tax law. One of the biggest things is bonus depreciation, which is everything in the green box. That's tangible personal property, leasehold improvements, and land improvements. So the 5 and 7 year, the 15-year assets are all non-structural. And so bonus depreciation applies. Currently, the bonus depreciation rate is 100%, which was brought back by the One Big Beautiful Bill, which means everything in this green box, the 5 and 7 year, the 15-year QIP, and the 15-year land improvements, now can be written off 100% of its value.
That's incredible. I was already excited to have 3 buckets that were faster than the 39 years, but now you're giving a bonus depreciation on top of it, which is great.
Exactly. Now, originally when bonus depreciation came around, it was like in the Tax Cut and Jobs Act of 2017, and it was 100% from the end of 2017 to the end of 2022. After end of 2022, the rate dropped 20% a year. So going into this year, it would have been 40%. The One Big Beautiful Bill came in the first part of 25, sorry. The One Big Beautiful Bill came in around Independence Day of 2025 and brought back 100% bonus. And that's now the law without a phase out. So that's going to continue until the tax law gets changed. So any new building that's built or purchased, if they do a cost segregation study and break it down into its component buckets, they can write off 100% of those 3 buckets combined value right now.
So go ahead, Dave.
Why doesn't every CPA automatically recommend this to clients?
That's a great question, and I wish I knew the answer. A lot of them they don't understand it. I mean, cost segregation has been around since the late 90s, so it's not something that's brand new, but a lot of people who are in the CPA field have been there for a long time, and so they just have never been exposed to it. The CPAs that are really looking to help their clients lessen their tax burden, they understand it. Now, CPAs are so busy, they don't have time to do this. And so this is a pretty niche industry, and you have to have a lot of resources to be able to do this. And so they don't have the resources, but they know that there's people like me that are out there. They just, for whatever reason, some are hesitant to go out and bring in outside help, which is wrong. I mean, I think some CPAs are kind of defensive because I'm essentially telling our clients that they've been getting screwed on depreciation by not using cost segregation. But at the same time, the CPA, it's like asking your general practitioner to perform brain surgery. It's not something they can do.
Right. This is very specialized than somebody who has commercial buildings and or large residential, investment properties needs to be coming to somebody who specializes in this stuff. Yeah, that makes sense.
Absolutely. So let me take it one step further and let's look at an example. So this is a building that's actually close to me. I'm in the Woodlands, Texas area. This was a building in my kind of neighborhood. It was recently built and finished in December 2023. 3-story building. It was a medical office building, 53,000 square feet, $12.8 million. And because they finished in December doing straight line, they would have had like a $13,000 write-off for that month. We did a cost seg study on it, applied bonus. So you can see there's a big piece of the building value, 8.6 million, is still in the building structure because it's a very massive building. But there's 1.1 million in tangible personal property and 3.1 million in land improvements. And unfortunately, this was in 2023, so it's at that 80% bonus, but still that's $3.4 million in total write-off in this year. And for 2023, even though there was 1 month, accelerated depreciation says you take it all when you've identified it. And that's compared to the $13,000 that they would have taken if they stayed with straight line. So this is a huge deduction to income, which means lower income, you're paying lower income taxes on that.
Oh, that's massive. I mean, and then even let's say it's, January 2023, it's done, and they've got I mean, you're getting that, you're having that full year of rental income. That's a massive, tax hit for you. If you can't bring that down, it's got to be completely gone with this 3.4 million depreciation.
A lot of people don't have to pay income taxes for a couple of years. If the building's big enough and they do a cost seg, if they don't zero out their income tax liability, they get pretty close. And so this is a great thing. That's what I said early on. I don't know why everybody doesn't do this. It's just that it's not that well known, unfortunately.
Well, then the difference is staggering. I mean, the difference in numbers from a traditional scheduled depreciation is just staggering. So yeah, great stuff.
Yeah, the one other thing to keep in mind too is that if someone bought a building and they've owned it for several years, this was something that was just built, right? So we got it right as it was finished. But if somebody's owned a building for several years, the great thing is you can do a cost seg study now. And if it's in that bonus depreciation range, as far as when it was built, we can still apply a bonus. It's just going to be the total bonus depreciation that you should have taken, and we'll subtract what you did record on straight line, and that difference gets recorded in the current tax year. The great thing about that is that you're not having to go back and amend prior years. You just take all that differential and depreciation currently in this year. And so going forward, you're whole. You haven't missed out on anything because you didn't know about cost seg for a couple of years. So that's a great thing that the IRS has made it a lot easier. And you don't have to amend. There's a form called the change of accounting method form that we can help you prepare. And that just says that I'm changing the way I handle accounting. I was doing straight line. Now I'm going to do accelerated. And oh, by the way, this is the differential that I should have recorded if I did accelerated from the very beginning, but I'm going to do it now. And we're going to record the difference. And it's also called a catch-up entry. So you're kind of catching up with the depreciation you should have recorded.
Yeah, you don't want to miss an opportunity. It's not, yeah, exactly. Just because maybe a couple of years went by and you didn't realize this was at your disposal. That's great. Go ahead, Dave. Sorry.
How do current tax laws affect the attractiveness of cost segregation today?
Well, the great thing I mentioned before is that the One Big Beautiful Bill brought back 100% bonus depreciation. And before that, there was a lot of kind of hand-wringing over it because 100% bonus sounds really exciting, right? 40% bonus is not as exciting, but it's still better than nothing. But there was a big drop in our business when the rate was down to 40%, because everybody would say, okay, there was Trump came back into as the president, and this is what, he brought 100% bonus to the foreground back in 2017, his first term. So everybody was waiting for him to get this passed. And so nobody wanted to do a cost seg study because they didn't want to be tied to 40%. They wanted the 100%. And they thought that it was going to be brought back and made retroactive. He didn't do that. He wasn't able to do that, but he did make it the law going forward. So anything that was bought or built after January 19th of 2025 now applies to 100% bonus. So that's kind of reinvigorated the whole real estate market again. The biggest help would be to lower, the loan rates, but this is almost the next best thing because they get a big deduction right after they buy a building.
Yeah. Well, that's really interesting you say that, because I think, the front page news is always what's the rate nonstop. And how does that impact the real estate market? But this is, not front page news, but has front page impact. That's for sure. So
absolutely.
What now? Anything else to do? So I'll have maybe another mop-up question. Dave is going to get into the rapid fire round in a minute and ask you some fun rapid fire questions. But other thoughts you want to share on this before we get to the rapid fire round?
Yeah, one thing that I always started, and this kind of fell into this recently, about a year ago, where people are not looking at the depreciation schedule just because they haven't. So this is an example of the depreciation schedule. If you can see my cursor, you've got the one line here. This is for the building value for the 522,384. And then you've got the furniture. This was for a short-term rental. It was like a vacation home, right? And so they have a land piece down here at $500,000. Well, that may seem high, but this was in Colorado. So you may say, well, it's Colorado. That's going to be expensive. The issue is this was a condo. So it wasn't something that had a lot of land. I mean, it was kind of like I guess it was more of a townhome, since it wasn't a high rise, but it was a freestanding building, but on a very small lot. So when I look at that, I go, 500,000 seems high, because I saw a picture of the property. I said, let's take a look at this. So we looked at the county's records. And the problem is that if you've overvalued land, you've lost the depreciation dollars. I looked at the county records. They had it at $125,000. Now, I went back to the property owner and said, why did you assign it at 500,000? Nobody knew. I went to the CPA, didn't know. Whatever,
Right.
Somebody made a mistake. And as part of the cost segregation study, we can make changes like this to reallocate the dollars. So like, a county form has the balance. So if we uncovered, $375,000, it's got to go somewhere. So we have to reallocate those dollars from land to building, which now the building value jumps up from 522,000 to 897,000, which is great for me as a cost segregation specialist, because I'm going to cost seg the heck out of that $897,000. And this was bought in 2020. If you see right here, it shows June 30th of 2020. So that means it's eligible for 100% bonus under the previous tax law. So now we can do a cost seg on that $897,000, and that's a heck of a lot more than the $522,000 that he would have done if I just took this at face value without doing some really investigation. So the whole idea, and this is going to use, like I said, the change of accounting method form, which is the same form we'd have to do changing from straight line to accelerated. So that's the one thing. Depreciation schedules are really important. Let me just cover this real quick. People need to review them. The problem is this is not a form that's typically submitted with a tax return. So when you get a copy of your tax return from your CPA, you're not going to see it. But that schedule drives the information that's on your tax return. The data from the schedule goes into the tax return. But if you don't see it, you don't know what the land value is versus the building value. That schedule stays with your tax preparer. So you're going to have to go and ask the CPA to show the depreciation schedule, and they're going to be a little nervous, and they're going to ask you why. So you say, I'm thinking about doing a cost segregation study, and I just want to verify some things. So that's why you have to ask to see it, because it's not typically something that you would see, because it's not on your return.
Where do you get that breakdown between when you own a property, the dirt, the land versus the actual building itself? Is that on your property tax records? Where do you get that data from so you can double check to make sure it's accurate?
Yeah, it could be on your property record. The county does break that down, and that's public public information, so you can see that. However, sometimes the counties get it wrong. So it really makes sense to talk to a commercial realtor, because what you have to do is if you own the property for several years, let's say 3 years ago, you need to find out what that value of the property is 3 years ago, not what the market value is now, but what it was when you bought the property. And some counties have
makes
that.
Perfect sense. I mean,
some counties have that historical information online, but some don't. And so that's why you may have to reach out to a commercial realtor.
Well, that's a good catch. And for those that didn't get to see the visual, obviously, I mean, dirt doesn't depreciate. So you want to check and make sure that the, building portion of your property is appropriately, it typically looks like it's going to be 80-20 or more, but 80% of the, value of the entire property is going to be on the building side. That's the portion you can depreciate, right? You're not depreciating the actual dirt. And so you want to make sure you've got a big number there on the building side so you can take advantage of a proper depreciation number and then cost segregate, as you noted, with an expert like Tom. So that's great. David, you've been waiting for the rapid fire. I know he's ready to go. So Go for it, Dave.
Do these strategies only apply to large real estate investors, or can small investors benefit too?
Great question. When it first came out, that was really just the larger buildings, but CSSI, the company I'm working with, specializes in bringing this down to almost everybody. So if you have a building that's valued at $200,000 and up, so you have to take out the land piece. So if the building only values $200,000, it makes sense to do this. And we offer free estimates, so we can give you an example of how much money you can save and what our fee is going to be. But yeah, this is for everybody.
Is there a point where a property is too old to benefit?
Great question again. Yes, if you've got a property, you've owned it like for 20 years or more, it's probably nothing that we can do to help you, because you've written off so much of it that those dollars you've written off is what we would have been accelerating. Now, if you've owned a property and then you did major renovations like 2 years ago, let's look at that renovation value, because that still has a lot of meat on the bone, if you will. This has a lot of value that we could accelerate faster. And I see that all the time too. They've done $100,000 in renovations and put it in at a 39-year asset. No, let's break that down. And that's what we look at when we're looking at depreciation schedule, to see if there's other improvements that haven't been segregated. We'll take a look at doing that now as well.
I'm ready for the rapid fire questions if either of you are.
Was it rapid fire? Oh no. Okay.
Best real estate book.
Best real estate book. Boy, you got me on that one. One of the things that have to understand is what your risk tolerance is. And so there's a lot of books that kind of go into that. And that's that one I would look at, because you don't want to get in over your head on investing, for sure.
Biggest tax myth.
Biggest tax myth is cost segregation, that it's only for the multi-million-dollar building. Like I said, if you've got like a dentist's office or something like that they built $200,000 and up, you can do this, and you don't have to do it right at the time you owned it. You can go back and look maybe up to 10 years after you've owned the building and try to do a cost seg.
Better buy residential building or industrial property?
If you're going to looking for cost segregation, it's going to be a commercial property, because there's more you can do, like on a rent house, you can do a cost seg on it, but you're going to have more valuable things that you can accelerate on a commercial building. Office buildings, medical office buildings are even better, because they've got dedicated electrical, unique plumbing things and stuff like that. So if you're going to buy a building, medical office building, or, kind of a urgent care facility, something like that, that would be great.
Stocks, real estate, or both?
I'm sorry, say the first part again.
Stocks, real estate, or both?
I would say both. Stocks go down in value. Real estate, I don't think ever does. So that'd be one thing to look at.
One piece of advice for a 25-year-old buying their first investment property.
Get a hold of your depreciation schedule and get the land and building recorded correctly. Because I run into this where people have owned properties for years. They've never done a cost segregation, and they have the land and building allocation wrong. So take ownership. Don't leave it up to your CPA. Ask questions and make sure you get things recorded where you're comfortable.
Those are all my questions. If you have any.
Yeah, that was great, Dave. Tom, that was fantastic. Let me, just to close this out. So folks that are listening to this, they've been investing in, whether it's residential or commercial real estate. They want to reach out to you, ask more questions, maybe use your services. How do folks get in touch with you if they need your assistance in saving with cost segregation?
Absolutely. They can give me a call. That's my cell phone number is 713-906-3710, or go to my website. The website is thefoundmoneyguy.com. That's one of those things where this is found money. When you're talking about cost segregation, people don't know they have access to it. And when you talk about tax incentives, people's eyes kind of glaze over. When you say found money, they listen, right? Because there's no better feeling than putting your hand in a pair of jeans and you pull out with folding money. That makes you feel like you're on top of the world. And it's only $1, but this is something you didn't know you had before.
Love it. Absolutely love it. What's some valuable insight for our listeners today? We will put that, right, Dave, in the comment section and the description, your contact, so folks can reach out to you directly for more information. But thank you so much for joining us. That was wonderful, really enlightening for our listeners. Appreciate your time. Anything else, Dave?
That's all. Thank you so much.
Well, I appreciate the opportunity, and this is something that every real estate investor's got to get done. They're leaving money on the table, and a lot of times I've freed up enough cash for someone to buy their next property.
That's perfect. Tom Brodie, the found money guy. I love it. Thanks so much.
All right, thank you.